It's Tariff Armageddon, and then it isn't, and then maybe it is again. Very sharp swings in the markets today as we get tariffs triggered by the United States against Canada, Mexico, and an additional 10% tariff on China on top of the ones announced last month. The markets seesaw violently around the news. And of course, the question now with all of us that are participating is this a bottom on the recent selling, or is this just a waypoint on the way lower? That's what we're going to tackle here. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And we're going to unpick this whole story. We're going to unpick what happened with the price action. We're going to see why this price action probably occurred and what it might mean going forward as some new event risk comes along, and how contact with this event risk might put us back on the defensive, not just in stock markets, but elsewhere too. So let's break this down. I look at the NASDAQ here as the stand-in for what equities did today, because the rebound that we subsequently saw from what you see was at one point a dramatic sell-off was really focused on the NASDAQ, and that's part of this story. So as we open today, as we mentioned at the top of the show, we got a bit of news that got markets clearly concerned. There was a month pause in the levying of 25% tariffs on Canada and Mexico after conversations that President Trump had with leaders of those countries. That sort of a delay expired today. Those tariffs went into effect. A month ago, China was hit with 10% tariffs on top of those that were already there through the first Trump administration and the Biden one. A further 10% announced today. So the markets looked at this and said, well, this is bad news. And at one point, the NASDAQ was down over 2.5%. The S&P was down over 2%. The Russell was down close to 3%. And then we got a dramatic intraday reversal. As we can see here, we were looking at the wicks on this candle, much lower than we ended up. Ultimately, the NASDAQ finished the day with a much more manageable decline, off only about 0.3%. And not surprisingly, the question then becomes, well, what gives? If the tariffs were such a concern, why? And if they then weren't a concern, why that? And it does, strange though it may seem, make quite a bit of sense. Why were the tariffs a concern to begin with? Well, remember that the sell-off in stock markets did not begin with the tariffs, not directly in any case. It began with this economic data you see on your screen. This right here, this start of the sell-off that you see, really starts to reflect economic growth concerns. And that's not just for NASDAQ, that's across the major indices. And the really big inflection point in this story comes a week from last Friday, a week back from last Friday. That would be, if you want to check it, February the 21st. And that is with the release of this PMI data showing that the service sector in the U.S. shrank for the first time in 25 months. This is, of course, as all PMI data centered around 50. That's neutral, neither growth nor contraction. Above 50 is expansion. Below 50, economic activity is shrinking for the given sector. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. So two things to note here. Number one, as we can see, services is overwhelmingly the driver of U.S. economic activity growth because the composite index that includes both services and manufacturing looks almost identical to the services line, while manufacturing kind of meanders on its own. This is not unusual. In fact, this largely is echoed in the performance of most major economies, and not just developed ones. China, for example, looks pretty much like this also. So services clearly is the main story here, and they weakened significantly in January. See that here. And the overall weakened with them, despite manufacturing starting to cautiously improve, or at least appear to. But it was really that slide in February, continuing for a second month, the cool off in services that got everybody spooked and thinking about recession risk. Why did this activity drop off occur? Well, let's go to S&P Global, who wrote the report. What do they cite? Growing concerns and uncertainty related to federal government policies. Meanwhile, the uptick in manufacturing linked to front-running of tariffs. Why? Well, consider what this means. When we look at the mix, goods to services, we find that the U.S. economy overwhelmingly imports goods, whereas service demand is primarily serviced domestically. So it is very much concerning that the service sector is worried about policy uncertainty, because tariffs don't inherently strike, at least not directly, at the service sector. They're much more focused on goods. And so when you consider what is happening here in total, you see that manufacturing gets a little bit of a pickup because manufacturers that use imported goods inputs into what they're doing, certainly for automakers, let's say, this is a very big deal when you consider how supply chains stretch across the Canadian and Mexican borders, for example. It makes perfect sense that on the expectation of tariffs, there would be a push to buy more stuff and to ramp up production and to build inventories. Because after whatever tariffs were threatened on the campaign trail and have been promised all along, finally arrive. And on the off chance that they don't arrive, well, good, positive surprise. But on the off chance that they do, you've managed to secure inventory at a pre-tariff cost level. So business leaders looking at the tariffs as a whole were already reacting where they were directly exposed. But the impact on sentiment in the service sector, which isn't directly exposed, that's the trouble here. And that sentiment was clearly deteriorating. That was reinforced by signs we saw in other data, certainly very similar echoes for very similar reasons in all of the consumer confidence data we've seen for February, be it from the University of Michigan or from the Conference Board. But most importantly, what we learned here is the problem isn't the substance of the economic hit from the trade war. In fact, anticipation of the trade war has been, if anything, supportive on the manufacturing side, as people try to front run that. Rather, the issue has been sentiment on the service side. And this is really the threat. Consider what we just saw from the latest CPI data, and we can see that all of sticky inflation is centered on the service sector. If we look at the actual contributions, we can see for the latest 3% rise in headline CPI, 2.6 percentage points was the service sector. Goods were a little bit less of a rounding error, but nevertheless that. And so when you look at what is actually driving U.S. growth and U.S. outperformance relative to other economies, it's very clear that it's the service sector that's doing it. Moreover, when you look at the contributions to CPI for January's report, what you find is that the service sector's contribution actually weakened, and that the uptick in headline CPI mainly had to do with the contribution from goods improving and the contribution from energy improving. And that mainly comes from those things going, in the case of energy, from negative to mildly positive, and the goods side from going to a lower negative quotient versus a slightly larger one. So this seems to confirm what the PMIs are warning us about. That the issue here really is the unraveling of the service sector. That's the threat to growth. And that the reason it's unraveling is sentiment. Because it is a concern about policy uncertainty that has businesses retrenching on spending, retrenching on investment, just waiting to save their money until the dust settles. Now, of course, we've likewise pointed out here that the markets are doubly concerned because of the outsized share that the U.S. service sector, in that it powers the U.S., the outsized share that it's had to play for global growth. We can see here 58% of global GDP is just three economies, and that's before we consider that the other 42% are mainly vendors to the former three. That is to say, countries like Mexico and Canada, in that rest of world 42% there, rely on demand from the U.S. in order to have a global GDP contribution, much like Central Europe or Nordic Europe relies on the Eurozone, Australia, New Zealand, Southeast Asia, and a lot of the commodity producers in Latin America or Africa, they're reliant on China. So if we consider then that the global economy is mainly driven by three engines of demand, we see how those engines have performed in recent months, we find that since the middle of last year, Eurozone and Chinese economic activity has trended lower and hasn't rebounded. It was the U.S. powering global growth, and in the past 2 months, that seems to be coming undone. Now, we have already seen over the course of January what this means. Of course, February was more dramatic, but we don't have full global data on that yet. As we can see here, Chinese numbers are still incoming. But as of January, we can already see that the unraveling of the U.S. is unraveling overall global PMI. There it is right here, the composite index in the dark line there in the middle. Moreover, we can see that global growth hasn't really moved ahead and has been begrudgingly drifting down since the middle of last year, despite U.S. outperformance. So despite this, and that is because, as we just mentioned, growth in the U.S. is primarily the service sector. And the service sector is primarily serviced by domestic firms. This is why U.S. outperformance has not spilled over globally for the most part. Now, on one hand, this means that the tariffs don't necessarily threaten U.S. growth so much it is driven by domestic demand and services, and perhaps that helps to explain why we got this seesaw. Yes, the markets initially didn't like the tariffs because they're a hit to growth at face value, but perhaps not such a hit if that growth is driven by services, as is evidenced by the CPI and the absence of the spillover from U.S. outperformance to other major economies. China is a ready spillover target, as is Europe. Both are meaningful goods exporters to the U.S., but because the breakdown has favored services and not goods, maybe this is not a big threat. So you get the seesaw. But then, of course, you are reminded that it's not about the threat to growth, as we've just discussed. It is about the threat to sentiment in the service sector from policy volatility. And so if you get this continuing, if this suggests, on the one hand, that the U.S. might be relatively impervious, at least U.S. growth might be relatively impervious in aggregate to more tariffs because it strikes at a part that isn't the dominant engine of expansion now, you nevertheless get a sense that if all of this back and forth creates more uncertainty and more retrenchment in a preemptive way from service sector leaders, as we've seen already, then this pullback in the PMIs very unfavorably threatens global GDP. You can see here the PMIs are a great forward-looking view on that. They track GDP numbers closely. They're just much more timely than the GDP numbers are. So it is with this in mind that we cast a worried eye on the ISM version of PMIs. That's incoming over the next less than 24 hours. We've already gotten the manufacturing side of the equation, and it was actually a bit weaker than expected, which already is a bit soggier than what happened with the S&P Global version of this data. Again, let's look over here, and we can see in the S&P Global version, manufacturing got a bit stronger in February, even though the service sector was a bloodbath. These numbers, on a survey conducted later than the S&P one, sentiment is already a bit weaker even in manufacturing. So you get near standstill, but the little sliver of growth that you do get is a narrower one than economists expected. Now we get the service sector number, and the real question is, do you get the same thing here as you do from the S&P Global version? And if that carries over into this, then the question about growth returns. The motivation behind this sell-off to begin with is very much back in focus. Because it isn't about tariffs on or tariffs off. It's about, does the U.S. service sector continue to power the economy? Looking at the U.S. Economic Surprise Index from Citigroup, we see that since about the middle of November, U.S. economic data started to deteriorate relative to expectations, and most recently has actually dropped below this zero center line to suggest that now U.S. economic data tends toward undershooting relative to consensus forecasts, which seems to bolster the idea that this is going to be a disappointing outcome, or at least the chance that it is. It skews risk of a surprise in that direction. So what happens if, in fact, this is a disappointing number? Well, as we just said, we again learn that the problem here isn't about what is happening with the tariffs as such. It is with the unraveling of service sector business confidence and consumer confidence alongside. So if we get a disappointing number, then perhaps the broader sell-off in equities resumes after today's back and forth. Moreover, we can see that the implications of these growth concerns have been to price in a more dramatic rate cut cycle from the Fed. You can see that in this dovish adjustment in policy expectations, both for this year and for next year. 68 basis points in cuts on the menu now for this year. That's 2 with a chance of 3. And 1 on the menu for next year for 93 basis points in total, almost in line, by the way, with the Fed's own forecasting of 100 basis points done in December. You get a weak ISM number, and this is going to get endorsed and perhaps see a further dovish shift, which might suggest beyond stocks falling that bonds, after getting stalled here at the early December highs, might continue to power higher as yields fall. And of course, the other way that you suspect that this is not about the tariffs, but more about sentiment is what happens with the dollar. The dollar gets crushed today, despite having rallied on tariff news before. See the euro here surging out of its congestive range and seemingly setting the stage for further upside. And that's because this is about the U.S. having a growth scare and maybe more rate cuts, which then means yield differentials shift against the dollar. Reiterating that this is probably a growth concern, not a tariff story in isolation. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things may go therefrom. I am likewise on with Chris Mondays and Fridays for Futures Power Hour, on with Victor Jones in a mere 30 minutes from now, as I am every Tuesday for The Price of Truth. Back with Victor and Tom for First Call Sundays, writing for the news and insights portion of tastylive.com and opining at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Price of Truth in 30 minutes. See you then.